Good morning. This is George Kachuk for RCM Wealth Advisors, reporting to you from the CME Group trading floor in Chicago. Well, here we are, a little bit past mid-November, and we're winding down earnings seasons, and the equity markets continue to perform pretty well. I mean, they've kind of been stalling a little bit, moving sideways in the last 2 weeks. However, we haven't seen any signs of any professional selling. So for now, basically, the trend is still up. Now, as long as the S&P holds that 2,000 level and doesn't crash through there, we're going to say the trend is still up. And same with the NASDAQ. NASDAQ stays above that 4,600 level. It doesn't crash through there. The trend is up. And on the Dow, the levels we're watching there is about 17,300. Now, we have seen some sector rotation, meaning the biotech stocks seem to be getting hit a little bit, and that was a very well-acting sector. So you might want to lighten up in that sector a little bit. However, the drug sector and other medical stocks continue to do very well. Transportation stocks continue to do very well. Semiconductor stocks continue to do well. The restaurant stocks are doing very well. So you might want to look at those areas for any new ideas as this market continues. Now, another sector that is doing much better is the financial sector, namely a lot of the small banks and credit card service companies. So one of the companies we're looking at today is called Alliance Data Systems. The symbol is ADS. And basically what they do provide credit services and marketing services for about 1,300 consumer-type businesses worldwide. They recently launched a new app where the consumer in the store can scan the store's barcode, apply right online, right on their phone, and then basically their phone becomes their virtual credit card specifically for that store that they're at. So that's a pretty interesting thing they have going on there. So sales for the company have been very good over the last 8 quarters, have been ranging in a range from about 15% to 23%. Earnings have accelerated the last 2 quarters, rising from 9% to up 20% to up 30% last quarter. Have a high return on equity, 97%. However, they do have a high debt load, so that's a little bit of a risk there. You need to be careful. It's about 850% their debt to equity ratio, and that's very high. However, analysts' estimates for next year are looking for an increase of 24% in earnings, and the year after that, 21% increase in earnings. Now, why we like the stock is it's been basically consolidating since March. It's had a huge run-up from 2011 till March, and it's been pretty much consolidating since then, correcting. And now it's formed a double bottom base where it's approaching a pivot point. That pivot point right now is about 288.60. And if it can cross that point on large volume, that might be our signal to try to play the stock. The stock's acting well, meaning coming up on the right side of this last consolidation. We saw a lot of heavy volume, a lot of accumulation. In fact, the stock over the last 8 quarters has seen a constant increase in the number of funds that are owning it. And what we're seeing is some good quality funds owning it, fund families like Invesco, Fidelity, American Century, Columbia. So has some good sponsorship, an increase in fund accumulation, so that's what makes the stock kind of interesting. So if it can break out on big volume past this 288.60 buy point, it's worth a shot. You know, of course, consult your financial advisor if this trades for you. And the way we would play it, if let's say the stock would reverse and drop below 275, you might say, maybe the stock is not going to work, or maybe the market's not right, or maybe the sector's not right. But anyways, do have a tight stop loss in this situation. So as always, let price and volume be your guide. This is George Kachuk with RCM Wealth Advisors, reporting to you from the CME Group trading floor in Chicago, and good luck trading.